first thing I want to show is the general market and how we determine whether you're making a top in the market. We've got the S&P 500 recently, and the arrows point to each one of the days where the volume had picked up and the market closed down. We used to a long time ago accept even just 3 or 4 days, but little by little as time has gone by, I guess the markets have been bigger, we moved it to 5 or 6 days over a short period of around 5 weeks, sometimes even 6. But this is simply just looking at a broad index and looking at the law of supply and demand, where you're getting more supply coming in, giving ground in a short span of time. And historically, when this happens, the market's going to roll over and go down. Now, we do not know how low it will go, but we have some techniques to track it. At this stage, it has been under distribution. It's in a downtrend, and it remains in a downtrend until it proves that it can come out of it. And we never pay attention to the first or second day, and not normally the third day either, because any decline can have a bounce back for a few days. So we start looking normally from a 4th day on to see, can it follow through with a huge amount of volume and a major increase in that same index. We only need one index to have all the distribution for us to turn negative. So when we see this beginning to evolve, we start selling stocks and raising cash, which we have done. And the amount of cash you raise, I think, depends on what stocks you've got and how many are ahead, and if you've got certain ones that you really believe in and you're doing well with. On the other hand, if this continues, you wind up probably going all the way to cash. Right now, you had the first day of an attempted rally, and tomorrow would be the second day, and we will count them and see if it can follow through. So no matter how strong it is on the first or second day, it doesn't mean anything to us. So at this point, we're in a downtrend. Now, this has saved us in some terrible, terrible markets. We got out of 2000, we got out of 08. So you don't know how long it's going down, but it will not miss a top. This is by far the best method, and all the other opinions, all the other technical indicators really don't mean too much to us. And I've used this for many years, and I've never gotten hurt in a bad bear market that's off 30, 40, 50% because we're out early. And the only problem on the other side is sometimes you get whipsawed on a follow-through that can be a little bit premature. However, I've learned over the years that when you have a follow-through, you start buying stocks. Because if you're looking at the news and listening to the news or following other things, the news will be so horrible and so terrible, you just won't believe it. So a lot of people, I think in March last year, may not have believed it and hesitated. I always buy on the first day, late in the day when I can see it's going to be a follow-through. I'll be buying something because I don't want to miss out. And we found that the biggest moves come out of follow-through days. And the stocks that break out within the first 1, 2, 3 weeks are usually your big leaders. Now, I know that in this particular market, a lot of people had trouble because it was such a steep correction that a lot of stocks, after all, when your market corrected 58% in the S&P, that means a lot of growth stocks are down 60, 70, 80, 90%. And the ones that we would be buying might have big, deep cup with the handles that are off 60, 70% or so. We'll get into that in just a minute later. But I want to show you a current situation where we have rallied now for almost a year, and there was some substantial progress made in that. But we had the distribution that we showed here, and there are a number of stocks that probably should be sold, even though they're good stocks, because you're going into a correction. But you have a decision to make to sit with the ones that you really believe in. If you really believe in Apple, and like we have a little bit of that, and we have some that was bought around 100, 105 or 10, and that we're sitting with, and others we cut back on a little bit. So tracking the market itself kind of gives you a guide to never let you get into deep trouble, but you can get whipsawed off and on. But I've learned to never argue with follow-through days. Even if you get whipsawed and it fails a few days later and it's premature, you would, if you were buying, say, 4, 5, 6 stocks normally in a normal uptrend, you would only have 1 or 2 stocks bought, and that's not going to hurt you. And so you just have to back out of them, and then you wait, and you get the next follow-through. The key point is you don't want to miss the follow-through, because I'm going to show you in just a second what occurred coming off of that March bottom. And a lot of people hesitated because the news is so bad, and they'd seen a few false moves just before that. Now, someone asked a question, and we'll answer some of these questions toward the end, about in the leader laggard service that we have with some institutions, that it didn't seem to perform quite as well as it had in the past. Well, one of the situations there is that when you take a 58% correction and a market that's down 17 months, that was the third largest correction in about 125 years. And you do a great deal of damage. In fact, more damage than I've seen in a long time, because it was an out-and-out panic. And even the government was stimulating that, saying this is the worst crisis since '29. If we don't do something immediately, a catastrophe is going to happen. So if anybody wasn't panicked and scared out of their stocks after that, I'd be surprised. So a lot of these stocks were down so severe that you had stocks that had sold at 50, 60, 70 that were at $1, $2, $3, $4 a share. And the bounce back effect of that is pretty huge. So a $4 stock goes to 12. It's a pretty big percentage. So the value people made real progress, and your growth stocks didn't start to show so much until a little bit later. But let's look now at, we'll go back to this institutional service, and I'll show you the specific stocks, some of the best ones that we came up with that were available right at the follow-through day, some a day or two before or after. And I'm going to go over 10 of them to show you that they were there, and your job is to learn how to read charts, not just okay, but with enough skill so that you can spot these little details we're going to talk about. Now, here's the first one, and I'm showing you exactly where we put it on our leader laggard service in the institutional area. If you'll notice, that was back right at the turn. As I mentioned, you had this 58% correction, and the leaders were all off, and we used a precedent. We like to have models of stocks in past cycles. We used a precedent of Chrysler and Xerox back in 1962, when you had a terrible market that broke down, and we can maybe show you that a little bit later, that you built a somewhat similar situation. Now let's look at, in other words, this is a bottom rounding out part of what is to become a cup with a handle. So you're coming down on the left-hand side, and the first thing that we want to note is we've circled there were 5 weeks in a row when you got way down and you'd undercut a prior low where you closed unchanged, and this was on some significant volume. So this is what we call heavy volume without further progress on the way down. That is showing institutional buying and support of the stock in those particular weeks. Now, then it rallies up again, and it rolls over, and you make a new low. So you had one breakdown, and now here's a second breakdown. It rallies up again, and you roll over, and you make a third low. Now, there's a psychology in the market, just like when you buy a base, and it's the first base, it works, and the second base works, but a lot of third stage bases fail because it's too obvious now. Well, this is just the reverse application of this psychological thing of stocks go down in 3 waves. After they've been down in 3 waves, almost everybody that can be scared out is going to be scared out. So what happened here, you had your 3 waves down, and you turn and rally up, and then you come down for 4 red weeks, and this third one, you see the volume picking up. Now, these are subtle details, but you're supposed to learn to analyze a chart accurately. You come off 3 weeks, but the third week, notice the close is only down a slight amount versus the close the prior week, how much it was down from its previous week. So you're coming down, and the volume picks up, but it doesn't go off quite as much. Now, this is a tough, tricky period. Look up above. The S&P average is rolling over. It's breaking like crazy. It's making new lows. You're having a real panic. And this comes off a little bit, but it does not make a new low. So you've got a divergence going on right there, that the market itself has rolled over to new lows, but for the first time after having made 3 new lows, it doesn't make a new low anymore, and it turns and starts rallying up. Now, if you look at a daily chart, we use that also in determining. We have a rule. It's the old Livermore rule that if you have a $30 stock and it penetrates a low and it comes back up through that chart by 3 points, that establishes a new buy point. So we were using that rule, but this was around a $90 stock, so we upped it to about 6 points. So when you got the divergence there, and we had 3 waves down, and we found at the first point we had 4 different weeks holding up tight, and we had quite a few weeks in the December area. I guess that's right around the 90, 95 area that closed in somewhat the same area. And then we saw that 4 weeks down on the third week, some volume picking up and it not coming off as much, and then failing to break down like the rest of the market. It starts outperforming the market, and notice the relative strength line is beginning to move up and starting to make higher highs. So that is where we put that stock on. Now, most people would look at that and say, how in the world could you possibly be doing that? Well, it comes out of experience and other models. Like I said, Xerox did the same thing in 1962, and Xerox was the big leader of the prior market with a new machine that I don't remember what the number of it was, but it was the first one where you could get hundreds of copies out without having to use wet chemicals and all of that. So they had a tremendous product, big earnings. So this was a repeat of that history. Now you'll notice it starts moving up, and it moves 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. We have some other studies that show if you move up 5 weeks in a row, that's usually a sign of institutional buying. So it pulls back and moves up some more. Then you see it coming out of a handle which drifted down, and you have your second buy point there. Now you've got your cup with a handle, but we were buying coming off of the bottom, rounding out of it because of the diversion that we had from the market and the other signs it was being supported in along the bottom for a number of times. Now we'll go to another one to show you. Netflix. Excuse me. Netflix actually had a little cup of the handle if you look at it carefully, and the prior uptrend was that period in the September 08 quarter. That's a prior uptrend, and the exact time it was put on the buy list was right over here. And of course, none of these stocks, when we're talking about the chart patterns and showing you how we would interpret a pattern, none of these stocks had weak fundamentals. So it is that unique combination of having big earnings and big sales or a high return on equity, some sponsorship, all these factors together with a chart being right that tends to make a big winner. Now, so you can see the initial buy point there, and your little handle had gone sideways for 2 or 3 weeks. You notice your volume figures in the black, showing some good volume on certain up periods, and that had a good story. You could, during a supposed recession that everybody was scared to death with, you could buy movies at a very cheap price. So that was one of the few ones that was closer to a high. Most of these were way down. So the fact that it held up better than others is also telling you something. And notice that the relative strength line went into new high way, way before this stock did. So it was bucking the rest of the market all the way down. So that was one. Let's go to Amazon and show you where Amazon was put on. Notice that some of these we're trying to show you where they came on relative to the follow-through day, because this is very important. This one happened to come on 6 days before follow-through, but again, notice coming off the bottom. Let's take the left-hand side going down, because you can tell sometimes if a stock is being supported. Notice there was 1, 2, 3, 4, 5 weeks that are red as you're coming down, and the volume's getting higher and higher and higher. But notice the last 2 red weeks that the first of the 2 closes up around probably about 40% off of the low, and it wasn't down as much as the prior week was down substantially, but this is on an increase in volume, and it does not close down as much, and it closes up off the low. That's showing you institutional support at that time. Then the very last red week that's down, and I'm in the phase where 1, 2, 3, 4, 5 weeks down off the top on the left-hand side. That red week has enormous volume, the highest volume at all, and it just doesn't go down much at all. So there's huge, huge buying supporting that stock right there. Now the market is so terrible that it does roll over and makes a new low, and you have the same sort of thing going on. You have 3 weeks with the volume looking terrible, and that third week, notice it does not close down as low as the second week did from its previous week. So this stock is being supported down in that area, and it turns when the market tries to turn. Now this was probably one of these false follow-throughs that was occurring about that time, but you move up and see where there are 3 weeks in a row where it closes unchanged in price. We call these tight closes. Institutions will be accumulating the stock all in that price zone. Then you see the first pullback you have is 2 weeks, and on the second week the volume dries up in and along the turnaround and in along the low. When the volume's drying up, that's saying there's no further selling coming into that stock. Then notice the enormous volume you got, the largest volume, and it closes right at its peak. So now the big institutions are really coming in and buying this stock. And the second week, it closes right at its peak. Now it closes sideways, and I think you see there are 3 weeks very tight in there. Maybe it's 4. It's a little hard to read this. But the tightness shows you're being under accumulation, and that's where we put it on. We're reading this pattern and all these things at the time, and we're also looking at that the stock has earnings growth rate of 149% and 33%, and then you had a 2-year annual sales growth 39 and 29. You had a return on equity of 33%, and this is interesting. The PE ratio 43. We don't ever let a PE ratio tell us not to buy a stock if everything else is right, because that's arguing with the market and telling the market it doesn't know what it's doing when it assigns 43 to one and 23 to another and 13 to one and 85 to another. So, but I wanted to put the PE up there to show you that we're not necessarily looking for stocks that have a reasonable PE, because that's somebody's personal opinion, and it's arguing with the market, telling the market it doesn't know what it's doing. So there's where it was put on, and you had 1 week that pulled back, and that's a normal handle. It undercuts slightly. Your handle should drift down along the lows low point, and it comes out there with volume picking up, and then of course you go up and you have other patterns developing, and then you come out again. So that was a stock that was picked up actually 6 days before the actual follow-through, but we had plenty of evidence that was telling us. And notice the relative strength, again, goes into new high ground way before the stock, so it's bucking the rest of the market. Let's see what else we've got besides Amazon. Here's Green Mountain Coffee. Now, some people have said all these deep, deep patterns. Well, this was not a deep pattern. This was one that held in there and was breaking the new high ground very early also. But look at the black volume on these up weeks, huge black volume. And we come up, and then you see the 3 weeks closing tight again, and actually it's about 4 weeks. Again, the sign that the stock is holding up in that area and being under accumulation. We put it on actually 2 days after the follow-through, as the stock started breaking out of its cup with a handle. And of course it had all the fundamentals again. You had 62%, 38%, 97% on earnings. The last quarter was up 38%, sales up 56%, the return on equity 19%. We want to see a minimum of 17%, and what we're really looking for is 25 to 50%. It's another way to measure profitability of a company. Pre-tax margins were 7%. We look at sponsorship. In this case, it had 8 quarters of mutual fund sponsorship increasing, and it had a PE ratio of 50. Now, oh, well, we can't buy that. That's too high. It's 50 times earnings. So you see how personal opinions can throw off people that have some rules that don't really come out when you go back and look at history. We studied all the stocks that had the biggest move each year, and we took year by year going back. Originally the study was 50 years. We now got a little over 100 years, and we found that PEs just don't make much difference. Some of them are low, some of them are medium, some of them are sky high. But the earnings got to be up and accelerating. The sales need to be there, the return on equity. And the other thing you need is you must understand what is the story, what's the product of this company, why is it so unique, does it make sense, is it really selling, because all these companies, those earnings are coming because they've got a superior product. So you've got to know the company, and that gives you a little more confidence to hang in there on the first 1 or 2 little corrections. Now you see this stock take off, and then notice that when it's breaking out, I mentioned about the 5 weeks, there's 1, 2, 3, 4, 5, 6 weeks in a row going up. So it's being bought steadily by institutions. You've got to realize if an institution has $10 billion under management and they're going to buy a stock, a 2% position, they're going to be buying it for 2 or 3 months. So because they can't get the position they want just in 2 or 3 days, it's an advantage that you have as an individual investor. You can buy something without having to take a long time to get it bought or sold. Now, even though that went up to 5 or 6 weeks, notice that it closes tight for 3 weeks. So there's a chance if you bought it right, breaking out, to add to it. I usually add to it at a point like that, but I don't add more than what I have before. So you watch carefully to try not run your average cost up too much. Let's look at another stock that we had. These are actual stocks that were put on the service. Now, using the service for an institution is not easy either, because we'll have a lot of names that don't necessarily do anything like this or maybe don't work. So how you use that service is we may have 80 or 100 names between our 2 different books, and each week you look at it, and each week there will probably be 2 or 3 stocks that are exactly at a buy point or very close to a buy point. So you've got to be able to interpret your charts accurately to see, okay, Cerner this week is in the right position, or Baidu is in the right position. So you have to weed down, and that's why the skill in the chart reading helps you weed out those that are so-so and focus on the ones that could tend to be the very biggest leaders. Cerner was a different kind of situation, a little more conservative. But notice on the left-hand side down, you had 3 weeks tight again. Now look very carefully we had 1, 2, 3, 4, 5 weeks breaking down on this stock. each of the first 3 weeks the volume picks up, and the third week is huge. And it closes up off its low, whereas the first 2 weeks were closed pretty much to their low. Now, so this one, if it closes 40% or more off its low, we say that's major support. So that's the stock was supported on that week, and the following week it closed the same, and the next week it was off a little bit, not much, and the volume was up a lot, but it didn't go down very much. So you had 3 weeks of institutional buying. Remember, the institution has 5 or 10 billion, will be supporting some of these things on the way down, companies that they know and like. So it goes back and forth, and then we have another period over there. If you'll skip 2 weeks further, you'll see 1, 2, 3, 4 weeks tight again. The same thing happening. Now the market starts to roll over, and one of these follow-throughs fizzles, and it drifts back down. And as the market is making new lows up above, this stock holds above its low back over in the December 2008 quarter. It holds up, and notice the black volume was high, particularly near the where it really turned for 2 weeks, very high, and peak closes. Then it sells off 2 weeks. Notice the second week is only down a tiny bit, and there's a tiny spread between the high and low. A pattern that's sound should have at least 1 or 2 weeks that are very tiny, where it's not fluctuating very much and people aren't really noticing it. So this one comes down for 2 weeks. Then the third week closes slightly up, but this is key. It's the black volume's higher than the red, and it closes up at its absolute peak, and you had 3 weeks off that were tight, and it holds up diverting, and it's going into new high ground over and over again on the relative strength. That's why we put it on over here. Now, and the volume gets bigger, and you even went sideways 1, 2, 3, 4 weeks once it was put on. So, and the stock goes up, and notice that it goes up and it hangs in there and doesn't come off very much. What happens when you have a major, major bear market and stocks move up, most people miss it because they're scared to death and they've been hurt throughout the bad period. So it's all psychology. So they're not willing to buy when they should be buying, but as it gets higher and higher, it just doesn't give them the opportunity for it to come back down a lot so they can buy. So it hangs in there and then just inches up higher. Finally, they throw in the towel and are buying, but they've missed the major move. So this is why you learn to buy on a follow-through no matter what you think, because the market will know what it's doing, and it will tell you what's going on. Now, notice the numbers here. Again, you had earnings growth, and you had profit margin. If you don't have a high return on equity, we want to see a high pre-tax margin. So this had everything that it needed, and it also performed. Now let's look at something else. How about VistaPrint? Now this is a thin stock, but again, it had the annual growth 44%, 51%. Last 2 quarters 36, 66. Last 2 quarter sales 44, 32. Return on equity 26%. PE ratio was a little more reasonable. Here's a young company not too many people knew anything about. But notice it comes up, and when you have the market bottom and the follow-through day, this stock breaks out of its cup with a handle. Now, that was a steep one and a little bit different than most, but it was drifting down, and you had all the earnings, you had everything else there, and it moves up, and there got, let's see, there's one period, 1, 2, 3, 4, 5, 6 weeks again, straight in a row up, and some tight areas. So you can read what I'm getting at here. You can read the charts week by week as well as the overall pattern. And sometimes you can see the accumulation occurring if you can read week by week. So once you develop a skill at chart reading, you've got a major edge. You'll see what's actually happening. And I think the problem is some people learn how to read charts a little bit, or maybe okay, or maybe fairly good, but you don't learn to really read it. How would you like to go to a doctor that you're going to have an operation with, and he doesn't read the MRIs very correctly, or he reads part of them, or the EKGs, or whatever else. You got to read them exactly what's going on, and you can learn to do that. It's just like anything else. It's like playing the piano or playing basketball. You got to practice, 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 and look at chart examples until you begin to see some of these things that I'm talking about. Let's go to the next one. CREE, C-R-E-E. Now, we don't normally like semiconductor stocks because they're twice as volatile as any of the others, and yet this one was acting better than any of the other ones coming off the bottom, and it had actual earnings. The last 5 quarters were up. Last 2 quarters were 50%, 43%. Sales were up 24%. Pre-tax margin was 12. PE, again, was very high. It was 41. But notice the relative strength is making a new high just a few weeks even before the stock breaks out of its area. It moves up, goes sideways, and we put some arrows on a whole bunch of these black weeks so that you can see that the stock was being accumulated for weeks and weeks and weeks over a long period of time. And those first 3 or 4 weeks, you can see the stock was relatively outperforming the market, but the bad market finally got to it. It corrects it a little bit, but it's still being supported. And you'll see some of the tight areas in the handle drifting off. There were 3 weeks that were pretty much the same. And then it comes out and the volume picks up. So that was, and I call these 10 black weeks we have there as skyscrapers, because if you look at it from a side view, maybe it looks a little bit like skyscrapers, and they're much higher. And all these were, I think, periods where it was higher than the average weekly volume. That's that red line moving through the bottom. So we're talking about analyzing supply and demand week by week and recognizing patterns that are showing a stock is stronger. And for example, you don't want the handles to be drifting up along the low. You want them to be drifting down, because after you move up off the bottom and get into the middle part or upper part of the structure, you want to have a little correction and get it out of the way before you start off on another big move. Let's look at the next one. That's price line. Coming down on the left-hand side, as you are hitting bottom, we're seeing this same supporting action. Notice the 3 weeks tight close, and the black week that's higher volume than the weeks before it or weeks after it. So that stock is being supported there, and it drops a little bit lower as the market is panicking. The second week of the red week is less volume, and yet it comes up probably 35–40% off the bottom. And then you have the same situation with closing very tight. Volume picks up and it closes up slightly, but you've got really, in effect, about 4 weeks in there that are all tight. Then it moves up again, and we have probably a false follow-through in the averages, and the averages roll over and come back down again. But now notice the tremendous divergence here. The market is breaking down to new lows it looks like that's maybe February, and this stock is moving up. It's moving up against the market making new lows, and look at the volume. It's huge. And you have 3 weeks tight again there, and the market comes off a little bit, and the 3 red weeks pulling back. On the red week, the volume is up much higher than normal, and it closes slightly in the upper half of its range for the week. It's being supported, and then you come out and break out, and you see where we put it on. There's where we put it on as a buy at that time. Now, every one of these stocks have earnings, and they have a return on equity, or they have pre-tax margins. So you see the 48%, 99, 48%, last quarter up 34%. This is in the middle of a 17-month bear market and in a recession. So the earnings are coming through, the sales are there, 44% return on equity. This is exactly what we're looking for. Huge profitability. PE ratio happened to be reasonable. Notice some of the peak closes there after it's breaking out. And again, we have 1, 2, 3, 4, 5 weeks or so of black movements up. When we go up, you go straight sideways. You don't come off very much. And we come out and go again. Now, at some point, you have a first phase of a breaking out, you have a second phase, and then when you start getting a third phase, now it's getting obvious, and those may fail. And we had a lot of flat bases up around a few weeks ago, and the stock isn't acting exactly the same. For the first time, we got a big volume week closing down. So the stock, in effect, has doubled in price. And there are some institutions that will cut back on something when it's doubled in price. We'll look at Baidu, and I've got a couple more, and then we're going to shift into something else, if everybody's still with us. This is Baidu. Now, Baidu is a very violent stock, much more volatile than most, and you can see the enormous correction it had. But remember, the S&P corrects 58%, so what does this correct? 70% or so? But as we get down along the bottom, you see it's beginning to get its support, and there's a heavy black week in there, and it drifts off a little bit, and there's less volume as it's coming down, and it starts turning up. Now, here's the interesting thing on this stock. Where it was being supported in there, when it starts moving up, it goes up 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row before we start realizing that, hey, this thing is steadily being bought. And notice most of those weeks are closing near the peak for the week. So this stock is being bought week after week after week after week, and there's actually 3 or 4 weeks in there that are fairly tight where they're closing. So we put it on at $200 a share, and it comes out of there, and you're still closing at the peak after that. So I don't know how many weeks we had there, but there's probably 12 or 15 weeks before it even had 1 week down. Then you move up into the upper part of the cup that is now being formed, and you have your handle, and it drifts down, and it's being supported properly. Notice the second week, just before it comes out of that handle, the 2 red weeks, that second week is not down as much as the first week was down from the black week, and it closes in the upper part of that small spread, but the volume is higher, so there's heavier volume without further progress down, and then the stock snaps out of it and breaks out the next week. So what I'm trying to show you is we're going through week by week. You can look at the handle area. You can see if it's being supported, and under accumulation, you had the first 3 or 4 weeks that were pretty tight, and the last 2 showed that it was being supported as soon as it bounced off the line, 10-week moving average line, the red line, for the second time. Moves up, and it bounces off the line again. And huge numbers, 45% return on equity, 39% pre-tax, all these numbers. That's why it's acting that way. Now, we have CTRP, and we've got one more after this. So this one moves up. Look at all the heavy red volume. So it's all supply and demand. Volume measures your demand, and you can see when you close one of those weeks near a peak, that's showing some pretty big demand, and you close in the tight areas, it's still under accumulation. So we see these same characteristics are showing up here, and when it gets up there and builds its handle, it goes sideways, and it's doing what it should do. It comes out of it. Again, earnings are there, 30, 70, 27, 3 years, 53, 62, 35. Last quarter up 19, last quarter sales 21. Return on equity 35. I said to you earlier, we're looking for 25 to 50% return on equity. Pre-tax margins 46. Look at that. How many companies make 46% before tax margins? How many companies make 35%? So what you're looking for is the top 1 or 2% of the stocks in the market. And we may have 50 names on a list, but there will probably be 2, 3, or 4 that are real leaders, and you've got to learn to recognize those and all the fundamental characteristics as well as the technical things. Now, the last one on our list is Express Scripts. This is a little different. This was using it was a double bottom, and remember, you're in a 58% correcting market, and this stock holds up and bucks it all the way because it's had a very consistent record. It's got an 88% return on equity. The pre-tax margins and return on equity were up 8 years in a row, 8 quarters in a row of increased fund sponsorship. So the numbers are huge. Now it's hanging in there and hanging in there, but it does on that last break. This breaks below its low. But when it breaks below that low, it hangs in there pretty well. And notice the volume now. When we start moving back up, the black volume picks up, and you get 3 weeks, and 1 week really jumps out of there. And that's where we put it on. Now, the reason for that is we were using this Livermore formula again. Look at your low back over in the January period, which is around 49.5, and the stock breaks below that and hangs in there. But when it comes back above the 49.5 by 3 points, right around 52.5 or whatever, that's where we put it on, because what they're saying is if you break below it but you don't go down substantially and you come back up through it the other way, by the time you get back up through that low by 3 points, you've determined that that was a false breakdown and you've established a new uptrend, and that's a buy point. And that's where we put it on. So now those are the ones that were some of the better ones. And all I can say to you about chart reading is if you're brand new to the market, or if you've been at it a while, or you're fairly good at it, you can't study enough models. You just have to study over and over and over until you see these patterns. You recognize historically these patterns. We can show you these same patterns years and years ago. They just keep repeating themselves because the market is supply and demand, and you've got big professionals in there all the time that are making these patterns develop. They're the ones that make them. The public does not make them because there's not that kind of buying power. So you're reading and interpreting the big professionals, whether the mutual funds now or whether back in 1910 it was J.P. Morgan and his buddies and their pools or whatever. The patterns are the same, and we've got 125 years of patterns. So we've covered that, and what I'll try to summarize for you is what I think are some of the critical things that anybody needs to really get down and learn to be as expert as possible if you expect to really do well. Those people that did really well, our top money manager last year was up 95%, and the lowest was up 10 or 15. So it's all over the place depending on how much experience you have and how much studying and working you're doing. But I think you see here that it can be done. And you may have been thrown by a lot of these patterns being deep cups, but if you knew some history, you'd realize that the patterns are all made by a correction in the market. And the worse the correction, the deeper some of those patterns are going to be. And that's why you had a Baidu coming off 70% or 75%. But you still have the same characteristic. It's just a bigger cup with a handle, and it can be justified because of the 58% correction. And you would be buying, coming off the bottom, some of these rounding out parts coming off the bottom of the rounding out part of the cup, which is what we did early on, because very few stocks were actually at a breakout point like Green Mountain Coffee and Netflix. You had 2 or 3, and that was about it. So everything else was coming up off the bottom like this. So I think you want to either subscribe to a chart service online. We have the daily graphs, and that's going to change to be called something like MarketSmith in March or April, and it's going to have a lot more of ability to go back and forth and do things with the charts. When you get a chart book, make some models of some past ones that were highly successful and just study them. Now, the How to Make Money in Stocks book has got 100 charts up in the front, and we've annotated it, and there's going to be another printing coming out on Amazon, I would say it should be out in mid-March or April. The revisions that we've put in there where we've annotated these charts a lot more, because I realize that sometimes people don't always recognize the subtle clues that are there. And we put 100 charts up front that started way back in 1880 all the way up to now, trying to show that history repeats itself. In other words, there'll be a pattern, and I annotate that on the chart showing, okay, this stock, say RCA in 1925, was exactly like the pattern of something else in 1965. And we'll show those patterns and even give you some of the page numbers so you can look at them and compare them. So what I'm saying to you is this is something that very few people know or do, that the patterns repeat themselves, and all you have to do is learn what a lot of the success ones looked like in the past and get very skillful at it so you can recognize a stock that is really under accumulation as opposed to one that looks like it maybe it's a pattern, but it isn't quite right. There's something wrong with it. It either is wedging up in the handle, or there's some adverse volume 2 or 3 times it shouldn't be there. All of these little subtly details are the things that will make the difference so that you can recognize when the next apple comes along. It's got a perfect pattern, and you see the big earnings are there and everything fits. So it's not just patterns, but it's all the fundamentals and reading a story on the company so you know it and understand it. In other words, it takes a lot of homework. You can't expect to learn this in just a few weeks. And if you're serious and you really work at it and you're in a meetup group like you have at Naperville, that's one of the very best in the entire country, and you work at it, you're going to get better and better. And you should be able to, at some point, come up with the big leaders. And that takes some time to do, but it's out there and it's been done, and we've got probably now thousands of people that have learned how to do this over many, many years. What I would suggest to you is just get How to Make Money in Stocks and read it 3 or 4 times. It doesn't do you any good to glance through it or read it once, because there are too many patterns, there are too many details, and you aren't going to get it the first time around, or maybe not all of it the second time. If you're a newcomer, I would suggest, this is kind of an unorthodox way, but you might take the first chapter and read it, and then go back and read it again, and then go back and read it again and make notes on it, and don't go to the second one until you understand the first one. Because by the time you go through one at a time all the way through, you're not going to remember most of the things you're seeing. And so you want to make a lot of notes, and you got to go back and reread. And now the next thing to learn to get better so you can pick out the real winners is that I would say in the first year or 2 or 3, you ought to, at the end of the year, always go back and look at all your confirmations and the stocks where you lost money. Get a chart book and post with a red pen exactly where you bought and how many shares you bought, and show where you sold, and separate out the ones where you lost a lot of money, made mistakes, put those in one pile, and then the ones where you did right and you made a good amount of money, you put that in a separate pile. And the key here is you must look at what you're doing and evaluate so you can figure out what are you doing wrong when you botch it up and lose money. And we all lose money. We all make mistakes. It's just that you learn that the mistakes after a while will become fewer. And one of the most vital things is if you buy a stock, let's say you bought an Apple and it turns out to be really big, but you sold it way too soon, or you sold it in a big correction and you were scared out and you didn't get it back, and so the stock doubles. So one that you almost had but you didn't handle it right, that is absolutely essential that you spend time studying that. And it's not that you're studying it to find out what you did wrong. It's you're studying it to find out what you did wrong, and then you sit down and write out a rule, figure out a rule that if that same situation comes up, how you will handle it in a completely different way with a whole new rule. Now, that's what got me started, is that way back many years ago, I had bought Certainty, which was running up rapidly, and it had a big shakeout, and I got scared out, and I didn't buy it back, and it doubled. And at the end of the year, I looked at that, and I said, wow, that was really a bad mistake. And what I learned, I studied the Certainty, and I found that when the stock broke out, it ran up it was 2 weeks, I think, 20%. I figured out that if any stock breaks out of a sound pattern and goes up 20% in either 1, 2, or 3 weeks, that I must hold it through the first normal pullback, and those pullbacks usually occur between 4 and 6 weeks, 3, 4, 5, 6 weeks out of the base. So I had to hold it for at least 8 weeks no matter what. Now, this is assuming that you're buying a stock with earnings and patterns are right and it's a CANSLIM type stock. So I had that rule. 1 year later is when Syntex came along, and it broke out of the base at $100 a share, and it ran up. There it is. It's a 3-for-1 split. I bought it right there, and it went up the 20% in 3 weeks. So I shifted into an automatic rule. I must hold it for 8 weeks, and so then 3, 4, 5, 6, 7, 8. By the time, and you have to hold it to the end of 8 weeks, it was 46, and I was ahead substantially now, which was, I guess, what would that, well, whatever it was, 40% or so. And at that point, I decided I had built up so many profits for that year that I was going to try to hold it for a 6-month capital gain, which was the rule at that point. And I did hold it for 6 months from the breakout point, and that was 1 day after the top, which is where it was sold. Now, the gist of that story is that I made a stupid mistake, and we all make stupid mistakes. I bought a stock that was a big leader, and I didn't handle it right, and it doubled, and I wasn't in it. And I had to figure out, if that ever happens again with a pattern like that and it runs up, what can I do that'll keep me from getting panicked out? And that I was on an automatic control rule. And also, look at Syntex very carefully. This stock ran up in the December 63, and see that red week where it drops from, it looks like that's around 77 to maybe 64 or something, and the blue week puts it even lower. I remember that time. One time it stopped trading and opened down 25 points. Now, but I had to hold it for the 6-month thing, and I was already ahead a huge amount. Then it runs up like crazy, and now it's on a before the split basis. It really corrects quite substantially, but it has its first pullback to the 10-week line, and I had to hold it through that, and that correction was from 85 to 65 or something. That was a huge correction. But if I'd gotten shaken out there, look at what happens. It turns from around $65 a share, and it triples in 1, 2, 3, 4, 5, 6, 7, 8 weeks. Now, it wasn't just a chart. The earnings were up 200%. The sales were huge. The profits were huge, and they had a new product that helped people's white blood count when they were taking chemotherapy treatments, and it had a perfect high type flag pattern. So, and the volume was all there. Everything was there, and it came at the right time and right place. Now, that's one stock out of hundreds, but you've got to learn to recognize which ones are the strongest, and particularly which ones have a great new product and they've got huge earnings, and you can enter it at a proper point. And even though you get the proper point, you've got to have rules along the way, otherwise you get scared out because they'll all have 2 or 3 pullbacks. So maybe we can go on and talk about a couple of other critical type rules that, whether you're new or been at it a long time, you need to get down. I mentioned earlier that you should be buying on a follow-through day no matter what you think. And if you get faked out a couple of times, you still come back the second or third time. You won't be fully invested because you don't buy everything the first day or two. You go little by little. Now, I think that a good plan would be to 3 out of 4 of your stocks, learn to buy them exactly at the right point, not chasing them 5 or 10% after they've broken out, because you do that, you're going to get thrown out with a lot of 8% losses. And I'd sell 3 out of 4 of those stocks when they're up 20%. Just take the shorter term gain. And if you own 10 stocks, it's only going to be 1 or 2 that might be like these really big winners. And the market will tell you which ones those are because they'll be acting a little bit better, and they'll probably have these huge earnings. So you can play a few others out for a longer time, but I would learn to buy something exactly right and nail down a gain. Otherwise, a lot of times you buy it, it runs up 20, 25%, comes right back down, and you wind up breaking even or making 2 or 3 or 5%. So I think that's a pretty good system. And the more rules you can follow and be strict and just act like a robot and eliminate all the distractions, don't take a whole bunch of other services, don't listen to a lot of analysts that are recommending this or that. Learn the system, learn the rules, and it's how you execute the rules. If you execute as accurately as possible, you're going to get better and better. Now, I'll take a few minutes here and go over and answer some of these questions. I'm not getting feedback from everybody, so I assume that they haven't all left or everybody's not asleep. I've got some questions that were sent to me. If Bucyrus broke out on the week of 12.25 and went up 20% in 3 weeks, do we use an 8-week rule in a non-growth stock that is near prior resistance highs? Well, I wasn't quite certain on this. It seems to me like that I've used that rule on initial base, either a couple of the handle or high tight flag, whatever. This was really a second stage base, and it's really looked like a growth stock even though it's been cyclical. But I don't think we would normally apply it there. Let me go on to another question that has to do with this same rule. CRE broke out on the week of 10-9, went up 20% in 3 weeks. How do you make the decision to stay or sell after 8 weeks? Now, this is a little different variation. CRE had it. One thing that would tell you maybe if you were going to play it out and try to hold it for 8 weeks, you had a big acceleration in earnings that came through after you bought it, breaking out of that pivot at 38.39. Notice that the slash mark in the earnings line shows exactly that was the 3rd week up. That was a 100% increase in earnings. You see on the angle on this chart showing it was a huge acceleration. So now you have some evidence that you did not have before. And then as you see it move up, you notice it's in tight 3 weeks. So there on 1, 2, 3, 4, 5, 6, 7, 8 week. At the end of the 8th week, it's high and tight, and you had a huge acceleration. I would definitely hold it longer. But now you can have your choice of what's your rule going to be. You might say, well, I'll hold it until it at least corrects and comes out of its first pullback to a 10-week line. Now, we do have a rule that says in some cases if you break rapidly for 1 or 2 weeks right straight back to the line and then you turn around and go right back up into new high ground for 1 or 2 weeks, you can sell it in new high ground because that's not a pattern. So it could possibly be sold there. Or maybe another way of looking at this is if you've read the story and you know the company and the LED lights they make and how they're in big demand and you have some earnings estimates, you can project out what you think it might earn and assign a PE to it. I use a PE that way. I don't use it to say, oh, it's too high or not. I use it to try to project a possibility of where the stock could go. So there are several different ways you could handle that. And the decision is, at the end of 8 weeks, you have to decide, okay, I'm going to sell it, or have I had further evidence that's come through that tells me this could be a big one and I need to hold it further. If nothing else, you might decide, well, I'll hold it for 8 weeks more. In other words, you did have two different bits of evidence, the 3 weeks tight and the acceleration, that would tell you got to hold it longer, and that would handle that. Now, some other questions here. Let me see. In the B2 section of IBD under how's the market, the indexes had a D, accumulation distribution grades, for almost 2.5 months, and yet the indexes continue to rally. What do we make of this, and how would we use this indicator? Well, no one ever said in my book that when an index shows a D that means you must sell. I think if they're showing E's, which we have seen more recently, I'd be a little bit more concerned, because that's some heavier distribution. But a D can be just a normal amount of selling that's going on, and some stocks are going through corrections and all, but I wouldn't use D as an indicator to sell. Your institutional leader and laggards talked about had an incredible return over the last 30 years, validating system. Why do you think that your leader had a lower return this year? We've also seen that CANSLIM's investors, who in general didn't have the typical first-year bull market returns, what was the investing lesson of 2009? Well, again, I would say that he's talking about this institutional service. You don't buy a list of 50 or 100 stocks. You've got to sort through and buy the 3 or 4 or 5 that have the very best price action and right patterns and huge earnings and that you know and understand. Now, let's see. Most of the big winners last year, there's one other point here. I think the value people are the ones that made all of the huge percentage profits, because things are coming up right out of the grave, and the growth stocks started coming on a little bit later in the phase. One other thing that we did is we had too many stocks that were real thin, like 100, 200, 300, 400,000 shares, and those are violent stocks that if somebody decides to sell them, they break down a lot. But nevertheless, I think you'll find that people that interpret the charts real well could have made 70, 80, 90%. Others could have made 25, 30%. And if you're learning, maybe you made 5, 10, or 15. And there's nothing wrong if you lost some money, but just learn from it, that's all. A few more questions. Most of the big winners were turnaround stocks with great price action but no earnings. In retrospect, is there a way, or should we have bought those type stocks? You don't have to buy stocks with no earnings, because I just showed you 11 stocks that had huge earnings. So you're saying that there weren't very many stocks around to buy. Well, that's true. There weren't as many, and there were a lot of things that dropped from 70 to 2, and some of them came out of it, but I'm not going to be shopping in that category very often. Let's see what else. How can CANSLIM investors handle earnings season in regulation FD? Well, I think the only answer, I don't like going into earnings season, because it's almost guesswork as to what a company is going to show. One way is to know the company backwards and forwards, and that will allow you to possibly sit with something that you might otherwise become afraid of. If you know it well enough, you know the product and know what to expect. And if you've been accurate on your chart analysis and you've got stocks that have real earnings and real growth, that's about the only thing I can suggest right now. Let me see. I'm going to assume that we can go on another 10 minutes, and then we're going to run out of time, and we'll let everybody have a break. Every cycle seems to have its own personality and small deviations from CANSLIM that can throw an investor off track if they are too literal and rigid with the application of the system. For example, the huge deep bases with overhead supply this time around and weaker earnings. I feel very strongly about this. You don't deviate, period. Learn the rules backwards and forwards and learn to read charts with great skill and have a lot of historical precedents, because the stocks were there for you to make 50 or 100%, but you would have had to really be good at it. And that takes time and studying. You don't change the rules. And here's why. Because the rules aren't my rules. We were smart enough to sit down and look at each year which stocks doubled or tripled or more and draw the patterns before they had that double or tripling and look at everything that was present there. And that's where we found all these patterns and found these huge earnings increases. So why would we want to change the rule from how all the big leaders in the past have actually happened? And on top of that, we have had, over the years, probably 7 or 8 years where we made 100% or more. Now, there are many years where we didn't do much of anything or maybe lost a little bit, but there will come a time back in 98, 99, people that were really on top of it made 200, 300% because the stocks were running wild and the bases were working and they wound up in climax tops. So my advice to you is the real problem is to learn the rules backwards and forwards and learn how to read charts backwards and forwards and keep on top of it and have buy rules as well as sell rules. And it's a skill thing, just like playing the piano. You couldn't learn to play the piano in 1 or 2 years, no matter how many lessons you had. So it may take you 2, 3 years, maybe 5, maybe 6 or 7. But once you figure it out, you have that for the rest of your lifetime. Let me see if I can read a couple more questions. The challenge I have in every cycle is identifying stocks which are true market leaders versus the stocks that I should hold and take a 20% profit on. Well, your true leaders will be the ones with huge earnings and that they come out of there and they outperform the others. And the market will tell you which ones are acting better. And it will be just a few of your stocks. And if you study the patterns of the really best ones, you'll be more apt to recognize the patterns of the really best ones in the future. We picked up Apple way back, I don't know, what year was it?
It's 2004.
2004, and we picked it up right straight off the chart. He'll see if he can go back and find that chart. And it was a perfect cup with a handle. And there you look at it right there. And we've got patterns that were exactly like that from several years before. So here in the December 03 quarter, it's going down, rounding out along the bottom, moves up, drifts down, perfect cup with a handle. We put it there right there. Now, we didn't even understand at that point when we came up with that what was going on, because Apple's prior record had been pretty spotty. So we didn't get totally carried away with it until it started really coming through. Now, it had a couple of big quarters there, but the prior several years was poor. But the point I'm making is you can come up with a big leader right off the chart, and the earnings were there for 2 quarters. They're up over 100%. So get your skill level there, and you can recognize more of those really big ones. Let's see. Do you place a lot of importance on the stage of a base breakout? For example, the recent breakouts from flat bases for Apple and Baidu, would you count these? And second or third stage base, count these and second or third stage bases? Well, we've said that the first base usually works, second one does. The third one you got to be a little bit careful of. It may work, it may not. Some of them work, but more of them will fail. So again, you've got to have a really great stock, and you probably will get away with it. Fourth stage base, I would say, will fail 80% of the time. What inning are we in this new bull market? Well, we're 11 months, and we have thought, although we don't try to predict markets, we just try to analyze them as they go, that this could last maybe 1.5 to 2 years from the time it turned around in March. And maybe we're trying to start an intermediate correction here. We'll just have to see how the market handles itself. Maybe it comes out of it fairly quick, or maybe it goes back and forth for 3 to 6 weeks. But you should get one more move out of it unless some more real bad problems occur. And we have seen bad things come out of Washington. So we just have to see how it goes. How concerned are you about recent distribution days? Well, when we have that many, we start raising some cash. And the amount of cash depends on the kind of stocks you've got and all. So there's not one particular thing there, but you start backing away. Let's see. How far from strict CANSLIM parameters should someone venture and still expect to be successful? Well, you're going to think that I'm a little narrow-minded, but I think the more you vary from it, the worse off you're going to be. You learn to follow it as strict as possible and execute accurately. I gave a musical example, but it works in music, it works in medicine, it works in athletics. If you stop and think about it, if you're playing high school basketball or baseball and you go to college and then you try to go to the professionals, you had better execute everything exactly right. And there is a right way to round first base, and there's a right way to slide into second, and there's a right way for the second baseman to throw to the shortstop to try to make a double play. You have to hit them right at the letters on the chest. You cannot hit them around the knees, because if you do, then the shortstop has to drop his arm and bring his arm back up before he can start throwing, and that costs 3 seconds, and you won't make the double play. So what I'm using a little example like that is trying to explain to you that don't try to veer all over the place with a whole bunch of other rules, because we've tested most of these other rules, and whether they're point and figure charts or candlestick charts or 8 million other things that are out there, and you've got to execute the rules that you have perfectly. And so I would not advise taking 2 other services or listening to 3 other things or trying to, and men tend to do this. They always want to tweak the rules a little bit and add this and add that and add this because they think that's going to make it better. Usually it will dilute the result and throw you off the track because these rules are not based on what we think or what we believe, but we've tracked every model and measured it, and these are the measurements that the successful ones have. So I'm not going to come up with that question again, I don't think. Let me see. What else? There are a couple more. I got a ton of questions, so I'll just have a few more and then we'll be over. Again, my concern is overtrading and whipsawing. I have been through since I started following CANSLIM and IBD. When you're whipsawed, go back and see exactly where you bought all these stocks. Did you buy them exactly at the pivot or exactly when it was bouncing off of a 10-week line? Did you buy it exactly right, or were you chasing it? If you're chasing it, you're going to get whipsawed all over the place. If you're buying at 10% or 15% away from a sound buying area, it's not going to work. So you'll get stopped out on a normal pullback. So again, you got to execute the rules and execute them right. And it isn't easy. It takes some discipline. But if you understand that you have to go through a chart book on the weekend or something and write down the ones that are possibly close to something and write down the buy points and then stay on top of it so that you can anticipate and be there when it reaches a buy point. Whether you if you're at work, you have to have some little device you can check on prices or whatever. That's, I think most whipsawing is because you're not buying correctly in the first place, or maybe you're buying a stock that doesn't really have all the parameters. Does it have sponsorship? Does it have some institutional volume in it? Is the chart right? Has it got all the other characteristics, the high return on equity? Is it the leader in its particular industry, or is it a number 4th, 5th stock in the field? So you got to do it all right, and then all of a sudden it starts to work much better. Here's another question. I'm embarrassed to admit that after working hard and trying to learn and execute CANSLIM since October 2003, I've lost some money. I'm not going to give you the amount, but that they said. But I would never get discouraged. I can tell you, I mentioned that one of our portfolio managers in-house was up 95% last year. Let me tell you his first year study, story that he told me. he came to work for us. He was in the research area, and they assigned him the area where he put into the computer analysts' earnings estimates. And he would say, oh my gosh, I've got the greatest job in the world because I've got all these estimates from all these analysts, and I've got really information that's very, very valuable. And so he sees this one report that shows an estimate of a huge thing for this stock. So he buys it, and he puts almost everything he has in it. He only had $3,000 or $4,000 at that point because he was young and starting. And he buys the stock. It's a $6 stock, and it promptly goes to $3. And he's panicked. He doesn't know what to do. Well, he sells it and loses 50% of almost everything he had. And then a few weeks later, the company goes bankrupt. So, and here's a guy that made 90% last year. So we all go through that. You have to make the mistakes, and sometimes you make a lot of them because the market's filled with them. You expect to. Just make sure that you keep them as small as possible, and then write down, plot on a chart where you bought them and sold them, and learn from it. And you'll come up with one or two rules that will be new, that I will not do this in the future, I'll do such and such. And you'll get better, and that's how we all get better. Let's see, you successfully trained many people and probably see people fail from the system. What are the key differences you've seen in these two sets of people? What does it take to turn around a person that is failing? Well, I'm saying it again. You got to look at exactly what you yourself are doing. You can't blame the broker or your wife or girlfriend or your brother, or you can't blame something else. You've got to look at where you bought a stock and where you sold it, and study the system and see, did I follow the system, or was I late or wrong, or was there something missing? Were the earnings really there? In other words, you learn through trial and error. The best thing you can learn, you build up your weakness until it becomes your strength. This is going to be the last question, and we're going to let everybody go home or whatever. It seems to me that certain portfolio management rules need adjustment based on the types of stocks being held. No. You need to get better at chart reading and applying all the fundamentals. You don't say, well, for this stock, because it's this way, I'll work with this kind of rule or something. There's no reason to lose more than 8%. So you cut losses at 8, and that should be the maximum. And as you get better and better at it, your average loss will probably be 5 or 6%. You don't need different kinds of rules for different kinds of stocks. Those rules were built based on, we now have 1,000 models of stocks that were outstanding in a particular year, and we looked at all those models. We've got certain patterns. We got certain types of earnings, certain types of return on equity. We say the minimum on earnings, you want to be up at least 20%, but what we're really looking for is 40, 50, 100, 200%. So there's a parameter. If you want to vary, you can buy something with earnings up 20, 30, or 40%. But what we're really looking for, you can buy something with 17% return on equity, but we're really looking for 25 or 50. Now, if you have only a 5% return on equity, you got to have a 15 or 20% before tax profit margin. So go back in the book and read all the rules. They're pretty flexible. You do not need to change it all around because you missed some of the things that were there that you should have seen. I apologize for blasting away for a year and for about a year and an hour and a half.